Wyckoff Stop-Loss Mastery, how to place them the right way. If you want to survive in the market, you have to change the way you think about money. Most people come in with their eyes on the prize, the big gains, the fast wins, the 10, 20, or even 50-point moves that they hope will make them rich overnight. Their minds are fixed solely on reward. They dream of wealth, security, and the life they imagine at the finish line. But here's the hard truth: that mindset is why most traders fail. They ignore the most important part of the equation, the part Wyckoff called the art of managing losses. Richard Wyckoff spent decades on Wall Street watching the same pattern repeat itself. He noticed that people weren't losing money because they picked the wrong stocks. They weren't failing because the market was unfair. They were failing because they treated trading as a game of chance, not a business. A professional trader thinks differently. Every decision starts with this question: how much can I afford to lose? Not how much can I make? This mindset is not pessimism, it's discipline, it's preparation. It's the foundation of survival. Wyckoff's observations were simple yet profound. He saw that the vast majority of market participants came unprepared. They jumped into trades based on rumors, tips, or hope. Meanwhile, a true professional begins with study. He prepares. He learns the market's rhythms, its patterns, and its rules. Wyckoff himself spent 8 years studying before ever making his first investment, and another 6 years before he began active trading. Knowledge was his capital. Without it, money is nothing but fuel for the fire. Treating trading as a business means more than just preparation. It means creating a process, a clear, repeatable method for identifying opportunities, entering positions, and most importantly, exiting them. Just as a merchant keeps records of inventory, purchases, and losses, a professional trader documents every trade, every reason, every outcome. A loss, when analyzed, is not a failure. It is tuition paid to the market, an education no one can buy. A trader who ignores lessons from losses is doomed to repeat them until their capital is gone. Discipline in learning is what separates the professional from the amateur gambler. From this foundation come the core rules of capital management. Treat trading like a business, or don't trade at all. Never overtrade. Always limit your risk. Ensure your potential reward is at least 3 times the risk. Overtrading is one of the deadliest mistakes a trader can make. It comes in 2 forms: trading too large relative to your capital, and trading too frequently without a reason. Overtrading destroys objectivity. It replaces calculated analysis with greed and impatience. Wyckoff observed that a novice with a 10,000 in capital often wants to trade 500 or 1,000 share lots immediately. They start at the top, then work their way down as losses eat through their account. The professional does the opposite. He starts small, tests the market, and grows size only as profits accumulate. Overtrading is not just a money problem, it's a mental problem. Fear becomes dominant. The trader closes winning trades too early and holds losing trades too long. It's a cycle of self-destruction. Once overtrading is eliminated, the next principle is risk limitation. And here is where Wyckoff's genius shines through. The stop-loss order is more than a tool, it is a philosophy. It is the trader's commitment to accept that he can be wrong and to survive when he is. No matter how confident your analysis, no matter how strong your conviction, the market can always prove you wrong. A stop-loss is insurance, not for profit, but for capital preservation. Think of it like insuring your house against fire. You don't skip insurance because you believe the house won't burn down. You pay a small, known premium to protect yourself against an unknown catastrophe. That's what a stop-loss does for your account. Here's the crucial insight: the stop-loss is not emotional, and it's not arbitrary. Most traders place stops based on fear, hope, or even random percentages of their account. Wyckoff said this is fundamentally flawed. The market doesn't care about your account size, your comfort level, or your hope. The stop must be placed at a logical point on the chart, the exact level that, if violated, invalidates your trade idea. If the market proves your analysis wrong, the stop executes automatically, preserving capital and your mental clarity. To move a stop in the hope that a losing trade will turn is to abandon business discipline and embrace gambling. Hope is the fastest path to ruin. Losses aren't punishment. They are lessons. They are tuition. They are the price you pay for knowledge. The professional executes the stop-loss without hesitation. In doing so, he protects his account, his freedom, and his ability to trade again tomorrow. Finally, all trading decisions must consider the reward-to-risk ratio. Wyckoff taught a simple but powerful rule: the potential reward must be at least 3 times the risk. This is not a guess. It is mathematics applied to probabilities. A trader can be right only half the time and still be profitable if the winners are significantly larger than the losers. The process is simple: define your entry, Place a logical stop to define your risk, project a realistic target for profit, and compare. If the reward isn't at least 3 times the risk, the trade is passed over. No emotion, no hope, no compromise, just discipline. This mindset, risk first, reward second, separates amateurs from professionals. It is the foundation for financial survival and the long-term accumulation of wealth. Without this, even the smartest strategies fail. Even the best stock picks are meaningless if capital is destroyed. By understanding these principles, treating trading as a business, avoiding overtrading, limiting risk, and ensuring proper reward to risk, you are no longer a speculator chasing luck. You are a professional, a disciplined operator, a steward of your capital. The stop-loss order is not just a safety net. It is the cornerstone of this professional approach. It ensures that every trade is taken with logic, executed with discipline, and managed with clarity. Master this tool, and you master the first and most critical step in the journey from amateur gambler to professional market operator. Now that we understand the mindset, the business-like approach, and the critical need for a stop-loss, it's time to go deeper, to the mechanics, the logic, and the science of placing stops. This is where most traders fail. They know they need a stop, but they treat it like a random number, a comfort zone, a guess, a percentage of their account. Wyckoff called this the arbitrary stop, the enemy of professional trading. A stop is not a number you dream up. It is a logical decision, directly tied to the reasoning behind the trade itself. Every trade has a thesis. Every trade has a reason. And every stop must be placed at the point where that thesis is proven wrong. That is the golden rule. The market itself tells you where the stop belongs. It is the point at which the logic of your trade breaks down. For a long position, the stop is placed just below a valid point of technical support. For a short position, it is placed just above a valid point of technical resistance. Nothing arbitrary, nothing emotional, nothing based on luck. Let's start with long positions, trades taken in anticipation of a price rise. The most opportune times to buy are moments of accumulation. After a spring or shakeout, the price dips below support, traps the bears, and then recovers. This is a classic Wyckoff setup. If you buy in confirmation of the spring, your stop must be placed just below the extreme low of the spring. Why? Because if the price revisits that extreme low, your thesis, that the bears are trapped and the market is ready to advance, is invalidated. The trade is no longer logical. The stop does its job. It cuts losses and preserves capital. Another entry scenario is the secondary test during accumulation. The stock dips toward the selling climax on reduced volume, proving that selling pressure is exhausted. Entering here is low risk, but the stop is placed just below the low of that secondary test. Any move below it signals that supply is not actually exhausted, invalidating the trade. Breakouts provide another type of opportunity. After a stock jumps across the creek, moving out of an accumulation range, it often retraces slightly, testing the breakout. This is your low-risk entry. The stop is placed just below the low of the pullback, often where old resistance has become new support. A failure here proves the breakout is false. The trade must be exited immediately. Even during established uptrends, stops are critical. A healthy trend is defined by higher highs and higher lows. Buying during pullbacks, known as stepping stones or reaccumulations, requires a stop just below the most recent reaction low. Violation of that low is the first sign that the trend may be ending. Your stop ensures that you exit the trade before a temporary mistake becomes a catastrophic loss. Now, let's mirror this logic for short positions, trades made in anticipation of a price decline. Here, stops are placed just above points of technical resistance. The best short opportunities occur at the end of a period of distribution. One of the strongest is after an upthrust, the manipulative move designed to trap bulls at the top. If you sell short in confirmation of the upthrust, the stop is placed just above the extreme high of the upthrust. If the price moves above it, your thesis that the breakout was false is invalidated. Cover immediately. Secondary tests of the buying climax also offer short entries. If the rally back up occurs on lower volume, the stop is placed just above the high of that test. Any move higher proves demand is still present, invalidating the trade. Similarly, breakdowns through support lines provide opportunities. When the stock rallies back to the underside of old support, this is a low-risk point to short. The stop is placed just above the old support, now acting as new resistance. Failure to hold this level signals that the breakdown is false, and you must cover the position. During established downtrends, stops are placed above the most recent reaction high. A downtrend consists of lower lows and lower highs. If a rally breaks the last reaction high, the downtrend is at risk of reversing. The stop protects you from the trade turning against you. In every scenario, the stop is directly linked to the logic of the trade. It is never random. But Wyckoff didn't stop at just basic stop placement. He introduced advanced techniques for professional operators. One is the odd fraction stop. Many traders place stops at even numbers, 50, 60, 75. Wyckoff observed that professionals in the market knew this and could push prices to trigger these obvious clusters of stops. The solution? Place stops at odd fractions, 1 to 8, 3 to 8, 5 to 8, or 7 to 8. It's a small adjustment, but it prevents getting shaken out on meaningless fluctuations. Wyckoff also warned about thinly traded markets. In stocks with low liquidity and wide spreads, a stop order may not execute cleanly. A stop at 70 could trigger at 69 or 68. Therefore, always trade active, liquid market leaders to ensure reliable execution. Finally, he introduced the double stop for advanced traders. For example, if you're long 100 shares at 61 and critical support is at 59D, a break here not only invalidates the long but signals a short entry. Placing a 200 share sell stop at 59 simultaneously closes the long and initiates a short. This is professional level agility and flexibility, the hallmark of a trader who thinks in probabilities, logic, and market structure. Every stop, every placement, every adjustment is about one principle: preserve capital, manage risk, and ensure trades are taken when the odds favor you. Mastering this skill is the difference between surviving and failing, between gambling and trading as a business. In the next part, we will explore trailing stops and how to manage profits like a professional, turning every winning trade into a systematic opportunity for growth. We'll also dive into the psychology of letting profits run, something the public consistently gets wrong. With the initial stop-loss firmly in place, protecting your capital from unexpected market turns, the next phase of professional trading begins: managing profits with discipline. Wyckoff emphasized that entering a trade is only half the battle. The other half, the part most amateurs get wrong, is knowing how to let profits run while systematically protecting them. This is the difference between a trader who merely survives and one who thrives. The cornerstone of profit management is the trailing stop-loss. Unlike the initial stop, which is placed to protect against a total loss, a trailing stop follows the market, adjusting in response to price movement. It is both mechanical and unemotional, enforcing discipline while allowing the trader to capture the maximum potential gain. The logic is simple: as a trade moves in your favor, you lock in profits incrementally, ensuring that a sudden reversal does not erase the progress you've made. Consider an uptrend, a series of higher highs and higher lows. You've entered the market at the bottom of a reaction or at a breakout point, and the price begins to climb. After the first healthy pullback, your stop is already in place below the reaction low. As the price continues to move upward, the stop is trailed higher, following the pattern of higher lows. Each reaction low provides a new reference point. By following this logical sequence, the trader allows the stock to breathe, accommodating normal fluctuations while ensuring that gains are not given back unnecessarily. The psychology behind this is crucial. The public often suffers from fear and impatience. They take profits too early, worried that a gain might disappear. Conversely, they hold on to losing trades too long, hoping the market will turn around. The professional does the exact opposite. A trailing stop institutionalizes discipline. It removes emotion from decision-making and replaces it with a systematic process grounded in market logic. Wyckoff also stressed the importance of the first move to break even. Once a trade has moved favorably by a sufficient margin, the initial objective is to move the stop to the entry price plus commissions and fees. This transforms the trade into a risk-free position. The psychological effect of this action is profound. The trader's mindset shifts from protecting their own capital to managing the market's money. Fear diminishes, clarity increases, and focus moves from potential loss to the optimal management of ongoing profits. From this point forward, the trader's goal is to maximize the trend while protecting accumulated gains. As the stock continues to advance, each successive reaction low becomes the new trailing stop reference. The process is methodical. The stop follows the price up, never arbitrarily, always at the most logical technical point. When the market eventually reverses, the stop executes automatically, locking in profits. There is no guesswork, no hesitation, no emotion. The trade ends because the market itself signaled the trend is over. Wyckoff described this method as the embodiment of his philosophy: let profits run. It is not about guessing the absolute top. No trader ever consistently catches it. It is about capturing the majority of the trend systematically, predictably, and unemotionally. A trader who consistently applies this principle will see dramatic improvements in net results, as small losses are controlled and substantial gains are preserved. For short positions, the logic is the mirror image. A downtrend, defined by lower lows and lower highs, allows the trader to sell on rallies and trail the stop just above the reaction highs. Each short position is managed with the same discipline. The stop follows the market down, ensuring that gains are protected, and any reversal triggers an automatic exit. Wyckoff also addressed the advanced use of stops for scaling positions. As profits accumulate, a trader can consider pyramiding, adding to a winning position while maintaining logical stops for the original and new entries. This is not reckless averaging up or down. It is a controlled, calculated increase in exposure designed to maximize trend participation while limiting incremental risk. Each added layer has its own stop, ensuring that the trade's overall risk never exceeds the trader's predetermined tolerance. One of the most subtle aspects of professional stop management is recognizing market structure and context. Not all reactions are equal. A minor pullback in a strong uptrend may warrant a tight trailing stop, while a deeper correction may require a wider margin. The key is to differentiate between normal market fluctuations and genuine trend reversals. This discernment comes from careful study of market behavior, volume patterns, and Wyckoff's classic phases of accumulation and distribution. The stop loss becomes not just a safety net, but a dynamic tool for active trend management. Another advanced concept Wyckoff highlighted is the strategic placement of stops to avoid obvious clusters. Public traders tend to place stops at round numbers or half points, creating predictable levels where the market can trigger multiple stop orders. Professionals aware of this tendency place stops at slightly irregular levels, 1 to 8, 3p8, 5 by 8, giving their positions a buffer against minor manipulative moves. It's a small adjustment with a disproportionate impact on reducing premature stop-outs. Wyckoff also warned of the dangers of thinly traded or illiquid markets. In these scenarios, a stop may not execute at the intended price due to wide spreads or fast moves. Professionals avoid over-relying on such markets, instead focusing on liquid, actively traded leaders where execution is reliable and stops function as intended. Discipline without reliable execution is useless. Finally, there is the matter of psychological mastery. No system rule or calculation will work unless the trader respects the stop and follows it without hesitation. The emotional pain of a stop being hit is inevitable, but it must be reframed as success, not failure. A triggered stop is the execution of your plan, the fulfillment of your disciplined process, and a safeguard for your capital. Understanding this transforms fear into confidence and hesitation into decisive action. In conclusion, the combination of logical initial stop placement, the break-even adjustment, trailing stops, and profit maximization forms the core of professional trade management. It turns trading from a gamble into a business. The stop-loss evolves from a mere defensive tool into a mechanical, unemotional extension of your strategy, ensuring that losses are controlled and gains are captured efficiently. Mastering this discipline allows the trader to transition fully from defensive survival to offensive opportunity, enabling them to ride trends with confidence, protect capital, and ultimately achieve consistent, long-term profitability in the market. Having mastered the placement and management of stop-loss orders, the next crucial skill for any professional trader is understanding reward to risk ratios and integrating them directly into trade selection. Wyckoff's philosophy was simple but profound. Every trade is a business decision, and every business decision must consider both potential reward and potential risk. Without this discipline, even a series of well-managed trades can fail to produce consistent profits. The foundation of this approach is the 3W1 reward to risk rule. Wyckoff taught that the anticipated profit on a trade must be at least 3 times the amount risked. This is not an arbitrary number. It is the minimum threshold required for long-term profitability. Trading is a game of averages. Even if a trader is right only 50% of the time, the math ensures that gains from winning trades will outweigh the controlled losses from losing trades. To apply this principle, the trader first determines the logical point for the initial stop loss, a level that invalidates the reason for entering the trade if reached. This stop defines the risk. Next, the trader identifies a realistic price objective for the move. Wyckoff recommended using point and figure analysis to project potential moves, which quantifies the cause built during the accumulation or distribution phase. The distance between the entry price and the projected target constitutes the potential reward. Only trades where the reward is at least 3 times the risk are considered. This discipline accomplishes multiple objectives. It forces patience, compelling the trader to wait for high probability setups, the AIF trades, rather than chasing low probability, marginal opportunities. It eliminates the temptation to enter trades with insufficient potential, a common pitfall for novices. Most importantly, it turns trading into a systematic, repeatable process, rather than a series of emotional gambles. High probability setups often occur at specific points within Wyckoff's classic accumulation and distribution phases. During accumulation, the professional looks for signs of selling exhaustion, such as springs or successful secondary tests. The optimal entry is near the bottom of these formations, where a logical stop can be placed very close to the entry, minimizing risk. Conversely, in distribution phases, the ideal short selling opportunity occurs near the top of a range after an upthrust or secondary test of supply, again allowing for a tightly defined stop and a large potential reward if the market falls. The key to these high probability setups is that they are anchored in market logic, not speculation. The trade is taken only when objective conditions support the thesis. This is the hallmark of professional trading. Every entry is supported by evidence, every stop is justified, and every potential reward is quantified. Wyckoff also emphasized position sizing in this context. Even a perfectly selected trade with a favorable reward-to-risk ratio can fail if the position size is too large relative to the trader's capital. The professional never risks more than a small, calculated percentage on any single trade. This ensures that a single loss, no matter how unexpected, cannot significantly impact the overall account. It is a core principle of capital preservation, which Wyckoff regarded as the bedrock of long-term success. Integration of stop-loss, reward to risk, and position sizing creates a completely systematic approach to trade selection. Each step reinforces the others. The stop defines risk, the potential target defines reward, and the position size ensures risk is controlled. The decision to enter a trade becomes purely mechanical, guided by rules, not emotion. The trader is free to focus on execution and observation rather than worry and hope. Wyckoff also warned against over-optimization or perfectionism. The market is dynamic, unpredictable, and often volatile. No method guarantees a perfect entry or exit every time. The goal is not perfection, but consistent application of sound principles. Over-analyzing every setup can lead to paralysis by analysis, missed opportunities, and emotional stress. Professionals understand that trading is probabilistic, and success comes from repeating disciplined processes over time, not from a single perfect trade. An often overlooked aspect of high probability setups is timing. Even the most technically sound setup can fail if the market is in the wrong context. Wyckoff emphasized the importance of studying market structure at a higher degree: trends, phases, volume patterns, and the behavior of major market participants. Trades taken in alignment with the broader market structure have a much higher probability of success, while trades against the prevailing trend or without confirmation from volume and other technical indicators are far riskier. Once a trade is entered, the focus shifts from selection to active trade management. The professional continually monitors the market, adjusting the stop as the price moves in favor, and evaluating whether the trade continues to meet the initial criteria for a high reward to risk opportunity. If the market structure shifts or the evidence that supported the trade is invalidated, the professional exits immediately, regardless of short-term losses or emotions. This is not hesitation, it is disciplined adherence to the rules of probability and logic. Another subtle but powerful principle is scaling into positions gradually. Instead of committing the full intended position size at a single entry, the professional may enter in tranches, allowing for better average pricing and reduced emotional stress. Each tranche has its own logical stop, and subsequent entries are justified by evidence, not hope. This approach increases flexibility and reduces the risk of catastrophic loss if the initial trade thesis proves incorrect. The integration of reward to risk, high probability setups, and disciplined trade selection is what separates amateurs from professionals. Amateurs often enter trades based on tips, rumors, or emotional reactions to market moves. Their stops are arbitrary, their targets undefined, and their position sizes reckless. Professionals, by contrast, enter only when conditions are justified, risk is controlled, and the potential reward is compelling. Over time, this systematic approach produces consistent, predictable profitability, regardless of individual trade outcomes. Finally, Wyckoff's philosophy emphasizes continuous learning and reflection. Each trade, whether winning or losing, is recorded and analyzed. Losses are tuition, teaching the trader to refine setup criteria, stop placement, and timing. Wins are studied to understand why they succeeded and how similar setups can be identified in the future. This ongoing cycle of observation, learning, and disciplined application turns trading from a gamble into a repeatable, reliable business. In conclusion, high probability trade selection is the natural extension of Wyckoff's rules for stop, loss placement, and capital preservation. By integrating reward to risk calculations, logical stop placement, position sizing, market context, and systematic entry criteria, the trader constructs a robust framework for long-term success. Trading is no longer about luck, tips, or emotion. It becomes a professional business with rules, discipline, and measurable outcomes. Once the professional trader has entered a high probability trade with a logical stop and a defined reward to risk ratio, the focus shifts to maximizing profits while preserving capital. This is where Wyckoff's principles for trailing stops and dynamic trade management become essential. The goal is to ride trends for significant gains while systematically locking in profits and reducing risk exposure. The cornerstone of this approach is the trailing stop loss. Unlike the initial stop, which is designed to protect against catastrophic loss, the trailing stop is a dynamic tool that moves in response to the market's favorable action. Its purpose is twofold: it lets profits run, and it prevents giving back significant gains. The trailing stop is not set at arbitrary distances, it is anchored to technical evidence, the structure of the trend, reaction lows in uptrends, and reaction highs in downtrends. In an uptrend, defined by a series of higher highs and higher lows, the trailing stop is moved incrementally just below each successive reaction low. After the stock advances to a new high and undergoes a normal pullback on diminished volume, the stop is trailed up behind it. This ensures that the trader remains in the position during minor consolidations and corrections while protecting accumulated profits. Over time, as the stock climbs higher, the trailing stop continually locks in gains, effectively turning winning trades into larger, more substantial profits. Wyckoff stressed the psychological benefit of the trailing stop. By using a logical, rules-based approach, the trader removes emotion from the decision-making process. There is no need to guess whether a pullback is normal or significant. The market itself defines the action. If the stop is triggered, it is not a failure. It is the disciplined execution of a pre-established risk management plan. This mechanization of discipline allows the trader to act consistently, calmly, and rationally in all market conditions. A closely related technique is pyramiding, or scaling into a position as it moves in a favorable direction. Wyckoff observed that one of the hallmarks of the most successful operators was their ability to increase exposure incrementally and strategically without increasing overall risk beyond prudent limits. When a stock confirms the initial thesis and continues to advance with strength, the trader may add to the position, using the same strict stop-loss discipline for each new tranche. The original capital is now protected by its initial stop, and subsequent entries are calculated based on updated technical evidence. Pyramiding amplifies profits, but it requires judgment and restraint. Many traders make the mistake of overextending, adding too much too quickly, or abandoning the discipline of logical stops. Wyckoff emphasized that every new entry must have its own valid stop and meet the same reward to risk criteria as the initial trade. This ensures that the overall position grows without compromising the safety of accumulated profits. Dynamic trade management also includes adjusting stops in response to changing market conditions. A professional must continuously monitor the broader trend, volume patterns, and price behavior to ensure the original trade thesis remains valid. If the trend shows signs of exhaustion, for example, a reaction low in an uptrend is broken, or an established downtrend fails to create new lows, the stop is adjusted or the trade is exited. This is not speculation, it is disciplined adherence to objective evidence, ensuring that capital is preserved and opportunities are maximized. Wyckoff also addressed the challenge of emotional attachment to trades. Many traders, especially novices, allow hope and fear to override logic. A profitable trade may be closed too early out of fear of giving back a small gain, or a losing trade may be held too long, hoping for a reversal. The trailing stop and dynamic management discipline eliminate this emotional interference. By adhering strictly to mechanical rules, the trader can capture the full extent of a trend without succumbing to greed, fear, or indecision. A key element of this process is risk-free trading. Once a trade has moved favorably by a sufficient amount, the first objective is to move the stop to break even, covering the original entry plus commissions. This transforms the trade into a risk-free opportunity. The trader can no longer lose capital initially committed. With fear removed, attention shifts entirely to managing profits. This simple step liberates the mind, allowing objective, focused decision-making for the remainder of the trend. Another advanced concept Wyckoff emphasized is the integration of multiple positions and exits. In complex trends, a trader may hold several tranches, each with its own trailing stop, while simultaneously observing the overall market context. Exits may be staggered, capturing portions of the trend at logical technical points. This allows for maximization of total gain while maintaining strict risk discipline. It also helps mitigate the psychological stress of attempting to capture an exact top or bottom. Wyckoff also introduced the concept of adaptive stops in volatile markets. In cases where price fluctuations are unusually large, the trailing stop may need to be set slightly wider to account for normal market noise while still protecting the position against meaningful reversals. Conversely, in a low volatility environment, the stop can be tighter, allowing the trader to lock in profits more aggressively. The key is that every adjustment is based on evidence, not emotion. Professional trade management also involves ongoing evaluation of market context. Trends do not exist in isolation. Sector strength, macroeconomic factors, and the behavior of major institutional players all influence the trajectory of a trade. By maintaining a bird's eye perspective while following the mechanical rules for stops and pyramiding, the trader ensures that each decision is informed by both the immediate price action and the larger market environment. In conclusion, the mastery of trailing stops, pyramiding, and dynamic trade management is the bridge between capital preservation and profit maximization. The professional does not simply protect against loss. They actively manage positions to extract maximum value from favorable moves. By combining logical stop placement, disciplined scaling, adaptive adjustments, and continuous observation of market conditions, the trader creates a mechanical, unemotional framework that consistently captures significant trends while minimizing risk. Wyckoff's genius lay in creating a systematic philosophy where every action, entry, stop, position adjustment, and exit is interconnected and based on logic, evidence, and discipline. This transforms trading from a gamble into a reliable business process, where survival is ensured and profits are maximized through the consistent application of timeless principles. The mastery of these techniques separates amateurs who chase noise from professionals who capture trends. It is the difference between surviving in the market for a few months and thriving for decades. Once a trade is underway and profits begin to accumulate, the professional trader faces a subtle but critical challenge: how to exit the position at the optimal moment without sacrificing discipline. Wyckoff's approach to exits is just as structured and business-like as his approach to entries and stop-loss placement. He emphasized that a trade is never truly complete until profits are safely realized, yet the process must remain unemotional, systematic, and grounded in technical evidence. The first principle of exiting trades is never to exit based on fear or hope alone. Fear leads to premature liquidation. A profitable trade is closed too early because the trader is anxious about giving back gains. Hope leads to disaster. A losing trade is held too long in anticipation of a miraculous reversal. Both are the hallmarks of an amateur mindset. The professional, by contrast, relies on the market structure to guide every decision. Exits are determined by the very technical points that validate or invalidate the trade thesis, not by personal emotion or subjective judgment. A common and highly effective technique Wyckoff taught is scaling out of a position. Rather than exiting all at once, a trader may gradually reduce exposure at logical technical points, capturing portions of the move while leaving room for the trend to continue. For example, in an uptrend, the trader may sell a portion of the position after a significant rally in the first reaction, locking in some profits, and then allow the remaining position to ride with the trailing stop. This method balances risk reduction with the potential for maximum gain, and it is a natural extension of the discipline established at entry. Scaling out requires patience and a clear plan. The professional defines in advance how much will be sold at each level and the triggers for each partial exit. This is not improvisation, it is a pre-calculated business strategy. By executing partial exits according to a plan, the trader avoids the emotional turmoil of guessing the top and instead relies on mechanical rules. Each step is governed by objective evidence from the market, ensuring consistency and reducing the risk of errors caused by overconfidence or panic. Wyckoff also emphasized the importance of letting profits run on the remaining portion of the trade. The trailing stop, which has already been moving to protect gains, continues to follow the trend. By combining partial exits with a dynamic trailing stop, the trader captures both small, immediate gains and larger, longer-term profits from sustained moves. This dual approach maximizes the reward-to-risk ratio while keeping capital protected, a core tenet of Wyckoff's methodology. Another key exit strategy is recognizing market signs of trend exhaustion. Wyckoff identified patterns such as buying climaxes, upthrusts, or abnormal volume spikes that often signal the end of a move. A professional monitors these signs closely, using them to trigger full or partial liquidation of positions. Crucially, these decisions are always evidence-based, not speculative. The trader asks, "Has the market invalidated the reason I entered?" If the answer is yes, the exit is executed without hesitation. If no, the trade remains in place. This approach transforms exits into a logical, unemotional business decision, rather than a psychological battle against fear and greed. Wyckoff also taught the strategic use of multiple exit points within a single trend. For long positions, these points could include the end of a secondary test, the completion of a trading range breakout, or the high of a reaction following a rally. For short positions, it could be the bottom of a reaction after a breakdown or a retest of resistance that fails to hold. Each partial exit is aligned with technical evidence, ensuring that profits are systematically captured while leaving the remaining position to continue riding the trend. An advanced principle Wyckoff highlighted is the integration of reward to risk calculations into exits. Just as trades are only entered when the potential reward is at least 3 times the defined risk, partial exits and trailing stops are designed to maintain favorable ratios throughout the trade. By scaling out and moving stops methodically, the trader ensures that even if the market reverses, the gains from previous moves substantially outweigh the losses from any single adverse reaction. This is the mathematical foundation of long-term profitability. Equally important is resisting the temptation to chase the market once an exit has occurred. Many traders, after selling part or all of a position, immediately re-enter on the next pullback without proper evidence. Wyckoff warned that this behavior erodes capital and undermines discipline. Each trade must be evaluated independently. The market does not owe a second opportunity. By adhering to the structured exit plan, the trader avoids impulsive decisions and preserves both capital and mental clarity. Another technique for maximizing profits is the use of staggered trailing stops for multiple tranches of the same position. For example, a trader may have 3 layers of a long trade: the initial entry, a secondary pyramid, and a third added on confirmation of trend strength. Each layer has its own trailing stop, calibrated to the most recent technical evidence. This creates a self-regulating system where profitable layers protect each other and where the trader can systematically extract gains without emotional interference. Wyckoff's philosophy also extended to the concept of patience as a profit multiplier. The trader must wait for the optimal technical conditions for each partial exit, rather than taking a small profit immediately. The combination of patience, trailing stops, and scaling out allows for compounding gains over the course of a trend. Even modest trends, if managed systematically, can produce exceptional results over time due to disciplined application of these rules. Finally, Wyckoff emphasized the psychological transition from defensive to offensive trading. The defensive phase focuses on capital preservation, logical stops, controlled risk, and survival. The offensive phase begins once a trade is in profit, scaling out, trailing stops, and maximizing trend gains. This dual-phase approach ensures that the trader never loses sight of risk management, even while actively seeking substantial profits. It creates a structured, unemotional, and highly effective framework for long-term success. In summary, exiting trades is as disciplined and strategic as entering them. And through scaling out, trailing stops, and strict adherence to evidence-based decision-making, the professional captures both small and large gains, avoids emotional errors, and maintains control of the trading process. Every exit, partial or complete, is predicated on logical analysis, reward to risk calculations, and technical validation. This methodology transforms trading from a game of chance into a structured business process where profits are maximized and losses are contained. Once a trader has mastered the fundamentals of stop-loss placement, trailing stops, and scaling out, the journey moves into the realm of advanced stop strategies and the navigation of volatile markets. Wyckoff recognized that the markets are rarely calm and orderly. They are full of sudden swings, unexpected news, and manipulative moves designed to test both capital and character. To survive and thrive, a professional must understand how to adapt the stop-loss framework to extreme conditions while maintaining discipline. The first advanced concept is the use of adaptive stops. While initial stops are based on clear technical danger points, the market's character changes as trends develop. Volatility, price gaps, and unusual volume can make rigid stops inappropriate. Wyckoff taught that a professional adjusts stops dynamically, always keeping them linked to the logical points that invalidate the trade thesis. For example, in a sudden market surge with unusually high volume, a stop may need to be widened temporarily to allow for normal fluctuations. Conversely, during periods of low volatility, the stop may be tightened to conserve gains and prevent giving back small profits. The key principle is that every adjustment is anchored in technical reality, never in fear or speculation. Another advanced approach is the concept of the mental stop versus the physical stop. A mental stop is a point at which the trader decides in advance that the trade will be exited, but no automatic order is placed. The physical stop is the actual order in the market. Wyckoff advocated for mental stops in situations where execution risk exists, such as thinly traded markets or illiquid stocks, where automatic orders might be triggered at unfavorable prices due to gaps or spreads. This technique requires discipline, The trader must honor the mental stop without hesitation. Mental stops cultivate awareness and mental control, while physical stops ensure automatic risk management. Wyckoff also emphasized staggered stop placement for complex positions. When multiple layers of a trade are in play, for instance, a pyramided long position, each layer may have a stop placed at a slightly different level. The purpose is twofold: to protect accumulated profits at each layer and to allow the position to breathe in volatile conditions. For example, the initial entry might have a stop just below the support level of the base, the second layer slightly below the recent reaction low, and a third added on trend confirmation with its own trailing stop. This staggered approach ensures that profits are captured gradually without prematurely liquidating the entire position, and it allows the trader to remain in the trend as long as the structure remains intact. Volatility itself is another arena where professional skill is tested. Wyckoff observed that inexperienced traders often panic during sudden moves, widening stops indiscriminately or abandoning positions entirely. The professional understands that volatility is not an enemy but a condition to be managed. During sharp swings, the trader may temporarily widen stops within logical bounds, always anchored to the technical evidence, while simultaneously monitoring the position for early signs of trend reversal. Volatility magnifies both risk and reward, and the trader who can remain calm, disciplined, and systematic can profit disproportionately from these conditions. A crucial tool for managing volatility is the use of volume and market context to validate stop placement. Stops should never be placed in isolation. They must consider the behavior of the composite market, the size of recent moves, and the location of key support and resistance levels. For example, a stock that has recently experienced heavy accumulation may be expected to have normal reactions of greater magnitude, requiring stops that accommodate these movements. Conversely, in a thinly traded or overextended move, stops may need to be closer to preserve capital against sudden reversals. Wyckoff stressed that the market itself provides the guidance for stop placement, not arbitrary percentages or fixed points. Another advanced technique is the use of double stops or reversal stops, which Wyckoff advocated for agile operators. This strategy involves simultaneously closing an existing position and initiating a new one in the opposite direction if a critical level is breached. For instance, if a trader is long and the stop is triggered at a decisive support violation, a double stop order can immediately flip the position to short, capitalizing on the emerging trend. This technique is reserved for experienced traders who can read market structure in real time and requires precise execution and careful risk calibration. Wyckoff also emphasized the importance of observing macro conditions and market environment when managing stops. In highly news-driven or gap-prone markets, traditional stop levels may be insufficient. The professional anticipates potential volatility, adjusts position size accordingly, and avoids over-leveraging. Stop placement is not just a technical exercise, it is also a strategic response to market context. This is why the professional never treats the stop-loss as a static rule. It is a dynamic, adaptive instrument that protects capital while allowing for maximum participation in legitimate moves. Psychology remains a central pillar of advanced stop management. Wyckoff repeatedly emphasized that the trader's mindset is the ultimate determinant of success. Stops are not punishments, they are tools of discipline. Accepting that a trade can be wrong and that losses are part of the business allows the professional to execute stops with confidence, free from emotional hesitation. Every stop that is honored is a victory for discipline, a reinforcement of the business-like mindset, and a reinforcement of the principle that capital preservation is non-negotiable. Finally, Wyckoff encouraged the integration of profit targets and stop-loss strategies into a unified framework. Every trade has an entry based on logical analysis, a stop based on invalidation of that thesis, and a target derived from point and figure projections or measured moves. Stops are continuously managed as the trade progresses, whether by manual adjustment or trailing techniques. This creates a self-contained, systematic approach where risk is defined, profits are protected, and decisions are grounded entirely in logic, not emotion. In conclusion, advanced stop strategies involve dynamic adaptation, mental discipline, and integration with market context. From adaptive stops to staggered layers, from trailing techniques to double stops, Wyckoff's methods allow the professional trader to navigate volatility, protect capital, and maximize long-term profits. The mastery of these techniques transforms the stop-loss from a simple safety net into a comprehensive risk management system, turning disciplined entries and exits into a sustainable, repeatable business process. Every tool, every adjustment, and every decision reinforces the central Wyckoff philosophy. Treat trading as a business, preserve capital relentlessly, and profit systematically from evidence-based opportunities. Having explored the foundational principles of capital preservation, the technical placement of stop losses, trailing mechanisms, advanced stop strategies, and volatility management, the final pillar of Wyckoff's methodology is the mastery of the trader's mind. Without psychological discipline, even the most meticulous system of stops, risk, reward calculations, and technical analysis will falter. Wyckoff repeatedly emphasized that the greatest challenge in trading is internal, not external. Markets will always present opportunities. The question is whether the trader can respond with clarity, patience, and unwavering discipline. The first mental principle is the absolute acceptance of uncertainty. A trader must internalize that no analysis, no matter how thorough, guarantees success. The market is influenced by countless factors: supply and demand, news, manipulation, and human emotion. Wyckoff described this acceptance as the foundation of professional detachment. The professional does not cling to the hope that a losing position will reverse or that a winning position will continue indefinitely. Instead, the trader acts according to probabilities, patterns, and evidence, using stops and risk-reward calculations as the mechanical enforcement of this understanding. By embracing uncertainty, the trader is freed from emotional overreaction and is able to execute plans with precision. Closely linked is the discipline of patience. Wyckoff observed that most traders fail not from a lack of knowledge, but from a lack of patience. They chase setups, enter positions prematurely, or exit profitable trades too soon. The professional understands that high-quality trades are rare and must be waited for. This patience extends to both entry and exit. The trader waits for evidence that confirms the trade thesis before committing capital, and once in the trade, allows the market to unfold according to its natural rhythm. Patience is reinforced by the 3-in-1 reward to risk rule. By waiting only for trades with favorable odds, the trader ensures that every commitment is worth the potential capital at stake. Another key mental skill is emotional neutrality. Traders who react impulsively to fear, greed, or hope undermine even the most rigorous systems. Wyckoff described the professional as someone who lets the market decide, not emotions. A properly placed stop loss, a trailing stop, and a risk-reward calculation are all mechanical enforcements of emotional discipline. When a stop is triggered, the professional does not mourn the loss. He sees it as tuition paid for a valuable lesson. When a trend moves favorably, the professional does not become euphoric. He continues to manage risk, trail stops, and respect the structure of the trade. Emotional neutrality transforms the market from a source of anxiety into a systematic arena where probability and logic dictate outcomes. Wyckoff also stressed the importance of reviewing every trade as a business activity. Beyond recording entries, stops, and exits, the professional trader analyzes the decision-making process itself. Why was the trade entered? Was the thesis validated by the market? Were stops properly placed and respected? Did the position size correspond to the capital available? This constant self-examination ensures that successes are reinforced and mistakes are corrected, creating a continuous cycle of improvement. A trade is never simply a gain or a loss. It is a lesson, a reflection of both market conditions and personal discipline. Long-term success also depends on developing resilience to drawdowns. Even the best traders experience losses. The difference between professionals and amateurs lies in how they handle adversity. The professional accepts that losses are inevitable and focuses on controlling risk, preserving capital, and staying aligned with the method. By keeping losses small, adhering to the 3-to-1 reward to risk ratio, and using stops wisely, the trader ensures that a string of losses cannot destroy the overall account. This resilience builds confidence, allowing the trader to remain objective and ready to seize the next high-probability opportunity. Wyckoff emphasized that trading is a lifelong discipline, not a game of chance. Mastery is not achieved through one lucky trade or a brief winning streak, but through consistent application of principles over years. This requires rigorous study, continuous practice, and a commitment to process. Even after decades of trading, Wyckoff himself continued to study price behavior, market structure, and human psychology. For the professional, learning never stops. The market is a teacher that is both unforgiving and generous, depending on the discipline of the student. The integration of mental mastery with technical and business principles forms the complete framework of a Wyckoff trader. The professional begins with careful analysis, identifies a logical entry based on evidence, determines precise stops and risk-reward ratios, and manages positions methodically. Alongside this technical rigor is the mental discipline, acceptance of uncertainty, emotional neutrality, patience, resilience, and continuous self-review. Each aspect reinforces the others, creating a self-sustaining cycle of professionalism. A critical final point is the recognition that trading is not about being right all the time. Success is determined by how much is won when correct versus how much is lost when wrong. The stop-loss enforces discipline when wrong, while the 3-1 reward to risk rule ensures that wins outweigh losses. The trailing stop allows profits to compound while protecting capital. Mental mastery ensures that emotions do not disrupt the system. Together, these principles create a business-like approach where every decision is informed, deliberate, and evidence-based. In conclusion, the journey from amateur to professional trader is a multi-layered process. It begins with the fundamental recognition that trading is a business and that capital preservation is paramount. It progresses through disciplined stop-loss placement, trailing techniques, advanced strategies, and volatility management. It culminates in the mastery of the mind, emotional neutrality, patience, acceptance of uncertainty, and constant self-examination. By integrating all of these elements, the trader transforms from a gambler reacting to chance into a professional operator managing probability, risk, and opportunity. This is the essence of Wyckoff's philosophy, survival discipline, and the systematic pursuit of long-term success. The stop-loss is no longer a simple order. It is a reflection of a business-like mindset, a technical safeguard, a psychological tool, and a pathway to consistent profitability. Mastering these principles is not easy. It requires dedication, reflection, and relentless practice. But for those who embrace them fully, the reward is profound: the ability to navigate the market with confidence, control, and clarity, turning uncertainty into opportunity, and transforming trading from a gamble into a sustainable, profitable profession.